All right, good morning. This is your daily briefing for Sunday, November 23rd, 2025. Over the weekend, we saw a pretty significant price move in the Bitcoin market, what's often called a Sunday squeeze. So let's break down exactly what happened.
The number you need to know from this weekend is $86,800. That was our high. This wasn't a slow grind up either. The price tore through several key resistance levels, which tells us this was a high-velocity, very directional move. And really, this quote sums up the entire situation perfectly. The bears who piled in over the weekend just got liquidated. This wasn't random price action. It seems specifically engineered to wipe out short positions. Anyone betting on a price drop got caught in a very rapid, very painful squeeze to the upside.
Okay, let's start with our overnight market snapshot to get a handle on the current tactical situation.
Right now, the price is holding steady around $86,500. But the really critical development here is that we've reclaimed the 200 EMA on the 4-hour chart. For a while, that was acting as major resistance, and now it's flipped to what should be a key area of support.
So looking ahead, the next major hurdle is 88,500. Why does this level matter so much? Well, a clean break above it would invalidate the recent bearish market structure. You know that pattern of lower highs we've been stuck in? Getting past 88.5 would be a strong signal that the trend might actually be reversing.
All right, so what actually caused this move? In this next section, we'll dig into the primary catalyst, which appears to be a massive liquidity injection.
You know, the market narrative here shifted on a dime. At first, everyone was focused on some FUD, fear, uncertainty, and doubt, surrounding a huge transfer from a Mt. Gox wallet. The immediate thought was, here comes the sell pressure. But that turned out to be completely wrong. It was just an internal transfer shuffling funds around. It had zero market impact, which means those initial fears were totally unfounded. So while everyone was distracted by the Mt. Gox story, the real catalyst was happening behind the scenes. And here it is, $2 billion. That's the amount of new USD that was minted at the Tether Treasury. This is the smoking gun. This is new capital entering the system, and historically, when you see a print this large, upward price movement tends to follow.
Okay, so we have the catalyst. Now let's deconstruct the market mechanics here. How did that catalyst lead to such a violent move up? We're talking about the anatomy of a classic short squeeze.
It really happened in 4 distinct stages. First, you had short sellers piling in, betting that the price would drop to around $75,000 over the weekend. Then, stage 2, the bullish catalysts hit. The empty Gox fears were debunked, and that massive Tether print was confirmed. Stage 3, all that new liquidity hits the market and just plows the price right through resistance. And that leads to stage 4, forced buybacks. The rising price triggers stop losses, liquidating all those short positions. And when shorts get liquidated, they are forced to buy, which creates even more buying pressure, and you get this cascading effect that fuels the rally even higher. It was, textbook, a perfect bear trap. And if you look at the broader market, everything seems to support this analysis. We saw a clear flight to quality, with money flowing into Bitcoin, while Ethereum and other altcoins were actually losing value against it. At the same time, we're hearing that inventory on the OTC desks is low. That means big buyers can't get their orders filled privately, so they're forced onto the spot exchanges, which just adds to the public buy pressure. When you put all this together, it really suggests that smart money was getting positioned for a strong week ahead of the Monday open.
Now, an objective analysis isn't complete without looking at the risks, and there is one primary risk factor we absolutely have to talk about. I'm calling it the gravity of the gap, and it has everything to do with the CME futures chart.
So, after a surge like this, the big question is, what is the single biggest risk for the bulls right now? What could pull this all back down? Well, the risk comes from a major disconnect between the spot price and the futures market. See, the CME, the Chicago Mercantile Exchange, stopped trading for the weekend on Friday. And when it closed, the price for Bitcoin futures was $81,400. That's obviously way below where we are now. That leaves us with a gap of roughly $5,000. In market terms, this is what's called a runaway gap. And historically, these things have a very high probability of getting filled. That means price often comes back down to close that gap. So that $81,000 level is going to act like a magnet for anyone playing mean reversion strategies. And to make things even more interesting, this risk is compounded by the calendar. It's Thanksgiving week here in the US. That means we're heading into the classic Thanksgiving lull. By Wednesday, liquidity is going to dry up significantly, and then liquidity can lead to some really wild volatility, making the market much more vulnerable to sharp moves, especially a move down to fill that gap.
So let's bring it all together in our final section, the forward outlook. Based on everything we're seeing, let's walk through the most likely scenarios for the week ahead. Okay, putting probabilities on it, we are assigning a 60% chance to a breakout validation scenario. On the other side, we're giving a 40% chance to a retest of support, which, yes, would almost certainly involve a move to fill that CME gap.
What this really boils down to is what the institutions do when they come online Monday. The 60% scenario is that the price holds here and we see institutional buying come in to validate this move. The 40% scenario, on the other hand, is that the CME gap acts as gravity and the price gets pulled back down to that $81,400 level to test support.
So that leaves us with the central question for the week ahead. Was this weekend's move a legitimate breakout driven by smart money, or is it just a volatility trap set right before a low liquidity holiday? The next 48 hours are going to be absolutely critical. That concludes today's briefing.